All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options midweek update for November 4th. This week has been completely dominated by the election headlines, and rightfully so. It's a huge event that can have a big impact on markets. And now that we're getting closer to the conclusion of the elections, starting to get some more clarity as far as winners, losers, and whatnot. What I want to spend some time on today is talking through how that impacts our trading here in the months to come. We'll also take a look at some new trades that are setting up for us here over the next couple of days. And also I want to spend some time, had some questions come in from people asking about how we manage the trades that we talk about here in our midweek update on Wednesdays and then our weekly recap on Fridays. We talk in those sessions about some of these new trades that we're looking at in the days to come. Once we put those positions on, what is our approach for managing those positions? I want to spend some time talking through that approach as well. As always, if you have any questions at all, feel free to post those into the chat. While you're reviewing the video here, if you're reviewing the recording, you can always send me an email directly, mike@netpicks.com. More than willing to help out there. I'm a little under the weather today, so if I pause a couple of times, just trying to take a drink here, trying to keep the voice active still. It's going quickly here today. All right, so let's start out like we normally do. Let's get a big picture glimpse as to where we're at technically on SPY. SPY is the S&P 500 ETF. We prefer to trade the ETF versus SPX, which is the S&P 500 cash index. The ETF, it's a lower price product, very liquid. It's going to be a better product for most retail traders. I don't trade SPX very often myself. I much prefer SPY. In this daily chart here, I don't use this to time my entry or exit points. This chart here is to strictly determine whether I want to be aggressive or conservative. Am I looking to trade my normal position sizing, or am I looking to cut back a little bit? This just gives me a good glimpse into what the overall market is doing here. And you can clearly see the last couple of days, really going back to the end of last week, it has been a pretty impressive rally back to the upside. Not necessarily surprised that the market has rallied. What does surprise me is the extent of the rally on the upside. There is still a lot of unknowns out there. There's still some gray area here with these election results. We still have the virus numbers starting to uptick. There's unknowns whether we're going to have another round of shutdowns here in the US. Are we going to get another stimulus plan? All of those unknowns are still out there, but yet this market continues to brush all that aside, and price action continues to move to the upside. And over the last 2 trading days, we have broken up through some very key areas of resistance. I am surprised that the market broke through all of these areas of resistance, all of these moving averages here, without really even pausing. It's been an impressive move higher. So bulls are firmly in control here as we go into the second half of this week. Where am I looking for support and resistance? The next area of resistance up above us. There's a few areas I'm going to point out here. In the very near term, 349 to 350, that's the first area that I am looking at for an area of resistance should this move continue to the upside. Over the next 24 to 48 hours, if we get another leg higher, that would be an area that I would expect some resistance to kick in. Above that, we have a swing high from back in the early parts of October, right around 354. That is another area that we're looking at for an area of resistance where we could potentially see price action stall out. And then beyond that, we've got the high. We've got the all-time high up at 358.75. So those are 3 levels. Should we continue to get this rally to the upside, those are areas that I would expect price action to, at least in the very near term, stall out. I'm not saying that we would completely fall apart from there, but we, again, very quickly are getting extended on the upside. So those are levels on the upside I had to be looking at. And now we just flip the whole deck, right? Because now we've got all of those moving averages below us that are support levels. First area there would be 341.50. Anywhere from 337 up to 341.50, that is an area of support should we get this thing to roll back over to the downside. The volume, no surprise here, volume has been impressive today. The volume has been good, not great on the last week and a half. It certainly has upticked, which is encouraging, but it's still not at levels that I want to see consistently. I want to see this continue to uptick, which very well could happen now that we have some of these unknowns out of the way, at least with the elections. We'll see if markets start to pick up again with everybody that was on the sidelines, just kind of waiting to see what happens after the elections. Now we'll see if people start to get back in. If we take a look at the internals today, very easy to come in and see that the index products are very strong. I mean, there's green on all of the index products. How strong is it truly? Well, here's what's interesting. If we take a look at the volume ratio in the upper left-hand corner, all this is simply taking a look at is how much volume there is on the stocks moving higher versus how much volume there is on out of those stocks that are moving lower on the session. Normally, if you would see the Dow up 700, the S&P up 100, the NASDAQ up 450, normally you would see those volume ratios at 5-to-1 positive. They're not there. On the New York Stock Exchange, the volume ratio is at 1.7-to-1 positive. On the NASDAQ, it's 2.48-to-1 positive. While those volume ratios are positive, they're not overwhelmingly so. I'll talk more about why that's important in just a moment. The advanced decline line in the upper right-hand corner. On the NASDAQ, the advanced decline line's at plus 589. All that's taking a look at is on the NASDAQ, how many stocks are moving higher versus how many stocks are moving lower. On a trending day to the upside, we would like to see that number at plus 1,000 at a minimum, plus 1,500 to plus 2,000. That'd be even better, but we're not there. Okay, it's only at plus 591. Why is that important? This is not across the board buying where every stock in every sector is moving higher. The names that are a big part of the overall market are certainly higher. Apple's up almost $5. Amazon's up 172. Facebook's up 21. Google's up almost 100. All of those key tech components are moving to the upside. That's where a lot of the strength is at so far today. On the tick in the lower left-hand corner, all that takes a look at is how many stocks are trading on an uptick versus how many stocks are trading on a downtick at that very moment in time. I look at this on a 15-minute chart. What I'm looking for here is clusters of either plus 1,000 tick readings on the upside or minus 1,000 tick readings on the downside. Those indicate buy and sell programs. We have only had a couple of buy programs right after the open. Okay, we had 2 plus 1,000 tick readings right after the open. The rest of the day, it's been pretty muted. We've been pinned between plus 800 and minus 400. There hasn't really been any strong buy or sell programs here the last few hours. We've just had this grind to the upside. Now, we are off the highs of the session, as you can see in the 5-minute chart in the lower right-hand corner. Very typical. We got way overextended here early in the session. We are now selling off. Where could we potentially find some support over the next couple of hours? That solid blue line is what's known as the volume weighted average price, or the VWAP. Really like to see that level tested intraday. It acts at price is drawn to that level. It acts as a magnet. We're starting to sell off. Wouldn't be surprised if we get a test of that level sometime over the next few hours. So that would be an area. It's currently sitting at 344.37. That would be an area that I'd be watching. So what is my takeaway from both the daily chart and the internals? My takeaway is the bulls have taken over control the last couple of days on that daily chart. We are in bullish camp, but based on these internals here, we're starting to see some readings that are tired. The last couple of days have been very, very impressive on the upside. It does not mean price can't head higher. It just means we're probably at a point in the near term, probably due for a pause or a pullback. Nice, healthy pullback before a potential wave back to the upside. How I would interpret that and how I would apply that into my own trading, not really interested in just jumping into long call positions here at this point because we have so many markets that are extended. If you want bullish trades at the moment, I'd probably lean more towards the vertical spread side of things just because we are extended and seeing some signs of some tired readings in the near term. I have been trading a lot of vertical spreads. As we've talked about here in these videos lately, we've been using a lot of vertical spreads for a few reasons. Number one, all of the uncertainty that we talked about here a few moments ago with the elections and the virus and the stimulus plan. A lot of that uncertainty has led to pretty big moves in both directions, but without a lot of follow through. The vertical spreads are going to lower the cost of those trades. They're going to give us more forgiving type trades that give us multiple ways of making money, and just a more conservative approach. Once we start to get towards the tail end of this week, potentially into next week, want to see what happens ultimately once we finally get the results of the elections finalized. I'll start to shift my focus more so towards the long calls, long puts, and start to get back into more of a normal trading approach. I've also been taking the most recent round of setups with between 50 and 75% of my normal position size. I have scaled back until we get past some of the uncertainty. Now that we're getting past the election part of those uncertainties, I'm going to start to get more aggressive again, get back to some of the normal position sizing that I look for. So with the elections out of the way, and it looks like we do have a Democratic victory here with Biden looking like he's going to take it. I'm not going to talk about the political side of things, just stating, what we know so far. Looks like we're going to have a Democratic president, but then we've got, it looks like the Democrats are going to also keep control of the House, but the Republicans are going to remain in control of the Senate. So is it going to be more difficult to get some things done? Sure. There could definitely be a gridlock here in the months to come. How do we trade it? What sectors, what stocks could I potentially be looking at? Here's the key part about how we trade at NetPicks. We focus purely on technicals. We like to focus on the most liquid stocks. When I say liquid, I'm talking about the stocks that have the best volume and open interest in their options. I am not looking to base my trading decisions, my entry and exit points, off of what we're hearing and seeing in the news. Okay, if you try to time that, if you're more of a fundamental trader, it's very difficult, in my opinion, to base your decisions off of that type of an approach. And especially when you're a short-term trader. We're looking to take positions anywhere from a couple of days on out to a couple of weeks at a time. What happens here first, second quarter of next year doesn't matter to me. It's going out too far. We'll address that when we get to it. What I'm focused in on is what's going to happen over the next couple of days on to the next couple of weeks. I want to focus on stocks and ETFs that have a consistent track record of moving back and forth and have good liquidity in their options. My watch list does not change all that often, regardless of what happens with COVID-19 or with the elections or with stimulus. I'm focused in on a consistent watch list of products. It's a diversified list. It's a mix of stocks and ETFs. It's a mix of different sectors. It's a mix of different price points. I want that diversification. What I don't want to do is try to dissect and say, okay, here's the outcome of the elections. How does that impact the stocks that we trade? Do I want to go in it and try to find a stock that would benefit from Biden taking over as president? I'm not looking to get into that approach. What I'm focused in on, okay, how does it impact Apple? How does it impact some of the financial names and the energy names, those names that are already established on my watch list? I'm going to stay consistent in with that approach. And it really simplifies things for me because now I don't need to pay attention to the news. If you're like me, paying attention to the news drives me crazy. I mean, it's amazing what they will do to get clicks and, to push out headlines that, get people to, tune in to a show. I don't want to mess with that. I want to focus strictly on price action on the charts. It's our opinion that any type of a news headline, any type of a news event is going to be priced into what we're seeing on the charts. And it's going to be priced in almost immediately. Now, are there certain events that you may want to cut back and get more conservative around? Sure. I mean, there's a few events. There's obviously the elections that we talked about recently, how that it impacted how aggressive we were being with our trading. I also do my best to stay conservative around a Fed statement and earnings releases. Other than that, I'm not looking to be concerned with the day-to-day news cycle. So looking at our 195-minute chart of SPY, this is the actual chart that we trade off of. I don't trade off of that daily chart that we looked at earlier. This is the chart that I base my entry and exit points off of. Looking at SPY, couple things to point out here. Number one, our trend strength indicator, that is the red and blue histogram down at the bottom, has flipped from red to blue. No surprise here. Over the last 24 hours, we have seen the bullish momentum take over here. And we are now looking at price action confirming on the upside. once I get that trend strength indicator to go blue, once it flips above the 0 line, I'm then looking for confirmation up top. And there's a couple of moving averages that I like to use. That red and blue moving average is our 8-period exponential moving average. The yellow and white line there, that is a 50-period EMA. And I'd like to use both of those for confirmation on our trades, but also for money management and trade management. So here on the upside, notice that we did get price action moving higher yesterday, but we ran right up against the 50-period EMA. And at least briefly yesterday, it didn't last very long, briefly, we did see some resistance kick in right at that level. Clearly, we know what happened today. We broke through that level overnight. We are now looking at a new long setup. Those blue plus signs on my chart represent my entry point. I am looking at a potential new entry at 348.48. That is the system generated entry point. Like I mentioned a few moments ago, ideally, before I put on a new bullish trade here, I would love to see a pullback first. You can see going back into last week, going into Friday of last week, I mean, we have seen a rally from around 322.50 all the way up to 346 here today, 340, almost 348 on the highs. That's an impressive rally. I don't really want to chase this higher if I don't have to. What my preference would be here, if we can get price action to pull back for a day or two, potentially pull back into those moving averages again, that would be ideal. That would set us up, in my opinion, for a more sustained leg to the upside. So that's the ideal scenario that I'm looking for. Pause first, and then a potential new long setup triggering in potentially later in the week or even early next week. That would be a perfect scenario for us. Over on QQQ, this is the NASDAQ ETF. The NASDAQ has been super strong, which is a very big shift from what we were talking about last week. The NASDAQ over the last couple of weeks has been lagging behind. It got its well-deserved rest, and that was the pause that it needed. Because the last 3-4 days, I mean, it has been a phenomenal rally on many of these tech stocks. Very similar to SPY, we did get our trend strength indicator to go from red to blue, indicating bullish momentum taking over. Price action today with QQQ up almost 4.5% today. Definitely saw both of those moving averages broken on the upside. And we are now looking at a new long setting up here at 289.29. Those are the two blue plus signs. Just like SPY, if we can get a pause first, if we can get a pullback over the next day or two, that would be ideal. Just to try to give us a little bit of a pause, build up some energy, and then break back to the upside for another leg higher. If this trade does trigger in, let's go over to the trade page a second, and let's talk through how we would potentially take this trade if it does trigger in over the next couple of days. 289.29 is the entry point there. Let's jump back over to the Thinkorswim platform. And let's go ahead and switch the symbol from Visa to Apple. Now, I've talked in recent sessions how I have been shifting my focus here over the last couple of days. I have been shifting my focus from the November monthly options out to December at this point. The November options are the ones with 16 days left to expiration. I like to typically be in that 20 to 40 day window. When you start to get less than 20 days out to expiration, the time decay becomes very significant. Not really interested in initiating new positions in those options with less than 20 days left. The December options have 44 days left. That's where my focus has been here so far this week on any new positions that I've put on. The tricky part there, I like to go out 44 days because, again, if we start to go out over 40 days, you're limiting the impact of the time decay. If you stick with the monthly options, you're typically using the options that have better liquidity. They have higher volume and open interest. The trouble there is if we come in, and actually I'm looking at Apple here. I need to switch this from Apple to QQQ. If we take a look at, let's just say we take a look at buying a long call here on that QQQ trade. And let's say I come in and decide to buy the 287 call. You're talking about $1,200 per contract. They're expensive for a few reasons. Number one, there's still 44 days left to expiration. So we're going out a little bit farther in time than what we normally do. And the VIX is still up close to 30. There's still a lot of uncertainty being priced into this market. When volatility gets high, the options get more expensive. Doesn't make it a deal breaker. I'm still open to buying options here. I just have to know that I'm going to pay up for that. They're going to be more expensive here. That's another reason why I continue to look at a lot of vertical spread opportunities. The vertical spreads, in many cases, are going to cut your costs by 30 to 50% or even more. The vertical spreads are definitely one way of reducing the cost on these positions. But for this trade, let's say that we do get up to 289.29. We'd need another $2 rally here on QQQ to see that trade trigger in. Once we hit that entry point at 289.29, what I like to do is I like to come in and take a look at the options that are typically 1 to 2 strikes in the money from the entry point on my chart. If we hit 289.29, the 289 calls at that point are going to be the at the money calls. That's the closest strike price that I could get to the entry point on my chart. If I try to get 1 to 2 strikes in the money from there, if I go 1 strike in the money, I would be looking at the 288 call. If I go 2 strikes in the money, I'm looking at the 287 call. So which one is it? Do I go 1 or 2 strikes in the money? For me, I like to then take a look to see if one of those options has a clear advantage over the other based on liquidity. I like to take a look, does one of those options have a higher volume and or open interest number? On the index products like SPY, QQQ, IW, I'm probably not going to have much of an issue there. You're going to be able to get filled on any of those products. They're very, very liquid. But when you take that criteria and apply it to some of the individual stocks or ETFs on our list, if it's not an index ETF, there's some stocks that you're definitely going to see a clear advantage of one of those options over the other solely based off of the liquidity numbers. So in this case, I like the 287 calls. They get me a couple strikes in the money. Again, I'm not looking to take the trade now because we haven't hit our entry point yet. I have to make sure price action on QQQ gets up and hits 289.29. So the trade remains valid for the time being. We'll see if we can get another leg to the upside. Who knows? It could happen this afternoon. It could happen over the next couple of days. So we'll just keep a close eye on it. So that is how I'm looking to play QQQ. Let's go over to a chart of Apple. Load this one back up here a second. So interesting situation setting up here on Apple because we have gone from a really nice, healthy pullback over the last couple of weeks to now, just over the last couple of days, Apple's come to life. Apple's up over 4% today. Our trend strength indicator down at the bottom has gone from red to blue. All right, so we are looking at bullish momentum taking over here. We're also at the moment seeing price action breaking up above the 50 EMA. That is giving us a long setup at 115.81. Just like QQQ, this trade has not triggered in. It hasn't hit the entry point yet. If it does get up to 115.81, yes, we could initiate a new long trade at that point. And what I would do to take that position, going over to the trade page, we would use that same exact criteria that we just talked through on QQQ. With our entry at 115.81, the 115 calls out in December, the December options with 44 days left, the 115 calls are the at the money strike. If I can get slightly in the money from there, that would be ideal. If I go 1 strike in the money, I'm looking at the 112.5 calls. They have plenty of volume and open interest, a lot of liquidity there. You're talking about at the moment, $725 per contract, a little bit pricey here, just again, because volatility remains elevated and we're going out 44 days. So if that trade does trigger in, the long calls, definitely one route to go to take that position. In a perfect world, I would love over the next 24 to 48 hours, if we can get a pullback first, that would be ideal. Kind of get a system reset or a market reset before we get another leg to the upside. I'd feel much better about that. That way we're not continuing to chase this move higher and higher before a pullback. Now, what I'm talking about Apple, for those of you that joined us last week for our midweek update and weekly recap, we had also talked about our pulse indicator, and that is the red and yellow histogram down towards the bottom of the chart. And going back into late last week, we had talked about how we were getting the yellow bars on the downside. When you start to get those yellow bars on the downside, it indicates an oversold condition. Why is it oversold? When it plots yellow like this, it indicates that price is between a 1 and a 2 standard deviation channel move on the downside. Doesn't mean price can't move lower from there. It just means it's not statistically probable. And we talked last week about how when you see those yellow bars plot, it will typically lead to either a sideways period of consolidation or a reversal in the other direction. We looked previously at previous moves. The last time we had those yellow bars was on the upside. That was back in August into early September. And that indicated price action was overbought. And out of that pattern, what did we get? We did get a pretty nice move to the downside. Now we have the yellow bars on the downside. And what's happened since last week? Last couple of days, we've seen a pretty nice little bounce higher. This pattern repeats itself all the time. And last week we had talked about taking advantage of that pattern through selling a put spread. Selling a put spread is a neutral to bullish position. Why wouldn't I just buy a long call expecting the stock to move higher? Because we weren't, as of last week, we weren't overly confident that the market was going to make a big move higher. Because at that point, we had still had a very bearish pattern in place. We had a lot of uncertainty in the market. So I wanted to lean a little bit more conservative. And what we did there is we sold a put spread. All right, and what we did, go over to the trade page, we utilized the November 20 options. They're down to 16 days left. But what we did is we sold the 103, 101 put spread. And I'm going to have to load up some additional strikes here after this move today. So what I did is I right-clicked on the 103 put, went to sell, and went to vertical. We sold the 103 put to open the position, and we bought the 101 put to make sure it was a risk-defined trade. We sold that spread last week, and we collected 58 cents. $58 per spread is what we collected to put the trade on. It tied up $142 of capital to put the trade on. Very reasonable cost. We just got done talking about how if we're going to put on a new long call position with Apple, we were talking about over $700 a contract. They're expensive. Another way to put on a bullish position on Apple with far less risk is to use a credit spread. And in this case, selling the put spread, instead of tying up $700 of capital, you're tying up $142. Much more reasonable for a retail trader, right? Now, sure, you can absolutely take multiple contracts, multiple spreads. Absolutely. If you take this with 10 spreads, yeah, you're talking about $1,400 of capital at risk. So it's a really reasonable trade for any type of account size. Now, ultimately, we wanted Apple to move to the upside, but we didn't need it to. All we needed Apple to do was to stay above 103. That was the strike price of the option, of the put option that we sold. Now, obviously, we can see what price has done. I mean, we've seen a pretty nice move higher the last few days, and now we're up above 115. Our spread is now trading for around 14 or 15 cents. Let's just call it 15 cents here at the moment, just for our example. If you buy that spread back for 15 cents, it leaves you with $43 of profit per spread. Doesn't seem like a huge return, right? Remember, I only tied up $140 of capital to begin with, and I had 5 ways of making money on the position. I made money if Apple moved up, down, or sideways, as long as it stayed above 103. I made money as time decay added up. Every day that passes, that helps me. And I make money if volatility decreases. The VIX is lower today. That certainly helped us as well. So it's a more forgiving trade. And it did produce a nice profit for us. Now, why would I close it out now? Why wouldn't I just hold the position? We like to close out of our credit spreads when I can book between 50 and 75% of my max profit. Why? Well, if we still have 16 days left to expiration, why not hold here? Apple's made a nice move to the upside. All I needed to do is stay above 103. I've got about a $12 cushion here, right? I've got about 8-9% cushion here that Apple could move against me and still make money. The problem here in this market, all it takes is one headline, one news event, and this thing can turn on a dime. What I would rather do is close out of the position, free up the capital for the next trade. All right, if I hold for the next 16 days, I only have 15 cents of additional profit potential. Right? I mean, it's $15 per spread. It's not a huge additional profit potential, and I still have my full risk on. So when you compare the risk reward here, it's, in our opinion, a better situation to close out of the position, book the profit, and free up the capital for the next fresh setup. We have found much better results when you can close out of those trades, avoid expiration week, book the profits early. So on a credit spread, our target zone is always when we can close out of the position and book between 50 and 75% of our max profit. And our max profit is whatever you collected to put the spread on. So this is a trade that we did close out of here today, booked a nice profit. And now we're looking for a new round of setups. Speaking of those new potential setups, we already talked about Apple and QQQ, SPY. Let's talk about retail here next. There's already talk of another stimulus plan potentially being in the works here. Any type of a stimulus plan going into the holidays should obviously bode well for the retailers, right? XRT is the retail ETF. We did see the trend strength histogram down at the bottom flip from red to blue. We have this bullish momentum taking over. Our entry point there is at 52.81. That trade did trigger in. So that's just, the system is in a long setup here on XRT. Jumping over to the trade page. Let's go back out and take a look at the December options again. Any new positions that I'm putting on, I'm more interested in December at this point. And if we take a look here, if I try to get slightly in the money, if I take a look at the 51 calls, they get me slightly in the money. Those 51 calls have 340 contracts of open interest, and 11 of them have traded today. I like the 51 calls here. They get me slightly in the money. They have enough liquidity. You're talking at the moment around $335 per contract. Very reasonable cost. Now, how would I manage a long call position? We just got done talking about how to manage a credit spread. How do we manage the long calls or the long puts? My initial target, anytime that I'm buying an option, is a 100% return. I'm looking to double my money initially. I can always adjust that. If market conditions change, what if we get the market to stall out here on the upside? I can certainly adjust that target in closer. If I start to get close to a support or resistance level, I can certainly adjust my targets. But I'm typically looking for between 60 and 100% on my returns on my long call or long put options. On a stop, on a trade that goes against us, on a long call or long put, if you're looking for an initial stop, we recommend using a 50% level. Again, you can certainly tweak it off that level if you need to, but that's a good starting point. Okay, so that would be a potential new trade there on XRT. And then talking about one of these specific retail stocks, Target was also jumping out at me here. XRT is a great way to get diversification because it's a fund. It's an exchange traded fund. So you're trading a whole basket of stocks, but Target also potentially giving us a new long trade here. Trend strength indicator flip from red to blue. Entry points at 159.73. So that's another potential new setup over the next couple of days. In an ideal scenario, again, on all of these new setups, I would love to see a pause first, see a market-wide pullback, even if it's just a small pullback. That way we can kind of build some energy for another wave to the upside. But Target definitely on my list for the next few days as well. The financials. We talked last week about potentially seeing a bounce in the energy names in the financials. Both of those have been lagging behind. Going back to last week, we have certainly seen the financials come to life. It hasn't been a huge bounce, but it's been decent, right? We now have a trend strength indicator that is gone from red to blue. Bullish momentum taking over. We have seen price action close above our moving averages. Looking at a new long setup here on XLF, entry at 25.15. Hasn't triggered in yet. That would be an entry point that I need to see hit before I jump in. But XLF, definitely like the financial ETF over the next few days if we can see the financials perk up again. XLE, the energy ETF, it also has tried to perk up a bit. You can see going back into last week, we talked here back last week about how we are looking for energy to bounce. It certainly has. XLE did trigger in. Entry point was there at 29.90. Even had you adjusted the entry point up above the 50 EMA, That level has been broken. So XLE looking for a bullish move higher here on some of the energy products. So that's another area that you can potentially look at over the next few days. So I think it's going to be crucial here over the next couple of days to see, can we get some follow through on the upside now that the elections are just about completed, unless something crazy happens. I guess it's 2020. Anything is possible, right? Nothing would surprise us at this point. But unless we get something crazy to happen, it looks like, we're going to have a new president, and we'll see if the market continues to rally up on that news. Again, we still have the virus numbers picking up. You still have the uncertainty with the stimulus plan. There's still uncertainty out there. That's why I would like to see a pullback before chasing these moves higher. We do have some Fed news coming up over the next few days as well. So we'll see what happens, but we're cautiously bullish on many of these names after the last couple of days, seeing if we can get a move to the upside. If you have any questions over the next couple of days, please feel free to contact me. More than willing to help out. I will try to come back on Friday. I would love to come on live. I guess it's just going to depend on whether I have a voice on Friday or not. Definitely under the weather here. So I'll do my best. If I can't do it live on Friday, I will get a video out, a recorded video out over the weekend. So if you don't see the announcements that I'm jumping on live, make sure you check our YouTube channel over the weekend, as I will post the recording of a video, just giving an update on where we end up finishing the week on many of these markets. All right. So I'm going to start wrapping up this video here today. Enjoy your afternoon, everybody. Good luck trading over the next few days. Stay safe. And we'll talk to you guys here as we wrap up the week on Friday. One minute to midnight asking, how do I make all my money 100 times bigger? So yeah, I mean, we all want to make as much money as possible, right? Absolutely. The key there is, especially for a retail trader, we have access to the limited funds, right? All of us do, regardless of whether you're using a $5,000 account or a six-figure account. We have access to limited funds. Very, very important to control your risk. Do not try to load the boat and say, hey, if I can just hit a couple of big winners, it changes the whole ball game for me. I promise you it will end in disaster, right? Because all it takes is a couple of losing trades and your whole account's wiped out. What I'd rather have you do is start slow. Focus on consistent growth over time. And as you grow that account, you can add in that second, third, fifth, 10th contract. Continue to grow it, keeping that risk small. You're going to be far better off for it. And over time, you're going to grow that thing. It's going to start to become that snowball that's rolling downhill. And you start to add in multiple contracts, and you're not changing anything system-wise. All you're changing is your position size. You're still keeping that size very small as an overall percentage of your account. You will very much be better off taking that approach. Now, you take a look, and there's dozens, hundreds of systems out there that are promising you the moon. They're promising you those instant riches, right? Guys, do not fall into that trap. I'm not saying you can't make good money from the markets. You absolutely can. But what I see so often is people get into trouble because they don't control the risk. They just shoot for the moon. They look for those instant riches, and that's what gets them into trouble. So what I would recommend doing, keeping your risk between 3 and 5% of your account per trade. If you can take that approach, you're going to be far better off than most other traders out there. So how do you make all your money 100 times bigger? You just continue to focus in on taking small trades, focus in on building an account size over time. That's the best advice I can give you. And that comes from, over the last 20 years, I've had the privilege of working with thousands of traders. I see what works and what doesn't. And trading too big is one of the biggest reasons most people fail to hit their trading goals long term. Yeah, you just need to double $1,000 10 times. I mean, it sounds simple, very much easier said than done. Right? If it was that easy, I mean, everybody would be doing it and making a killing, right? In order for you to see those types of returns, the probabilities are not in your favor, because as you start to throw everything that you have right, into those trades, all it takes is a couple of losing trades and you're wiped out, right? So what I'd rather have you do is keep that risk very small. Take a whole handful of small trades and continue to grow that account over time. Zakia, sorry if I'm saying your name wrong. Would you prefer to buy call options 1 month out or 1 year out? So it just depends on your outlook for that market. Our typical holding time is my universe is looking for what the market's going to do over the next 3 to 30 days. You start to go out 6 months from now, you start to go out a year from now, way too much can happen, especially in today's market, in today's whole economic environment. Too much can happen. I can't predict what's going to happen 6 months from now or a year from now. I don't think anybody can. What I'd rather do is focus on what's happening in the near term. So to answer your question, I prefer to trade options that have between 20 and 40 days left to expiration. That's what we have found the best results with over time. All right. So if you need more detail on that, let me know. And when I say options with 20 to 40 days left, that could be a weekly or a monthly option. Does not matter to us. If you use the weeklies, that's fine. Just make sure you're trading weekly options that have decent liquidity. So you have good volume and good open interest, right? Don't try to chase those cheap weekly options that have no liquidity. And there's a lot of those options out there. So I have been trading way more monthly options here the last couple of months. And I continue to do so right now. Like today, we talked about using the December options, the options with 44 days left. I feel more comfortable in the monthly cycles right now, just from the liquidity perspective. So hopefully that helps answer your questions. If you have any other questions, feel free to type those in now. Otherwise, again, I am going to wrap it up here for the day. Appreciate the feedback. Appreciate the interaction here. Feel free to post those questions here in any future sessions as well. All right, guys, enjoy your afternoon, and I will talk to you all here on Friday as we wrap up the week.